business should you be buying? Should you buy a $500,000 business or should you buy a $5 million business? It really depends. And in today's video, I'm going to help you identify the exact purchase price you should be going after based on the resources you have. Let's get to it. Welcome to my channel. I am your host, Leo Landaverde, business broker and commercial lender, helping you buy and scale a profitable business. If you are a small business owner looking to increase your wealth by purchasing a profitable business, or a W-2 employee looking to get out of the rat race by purchasing a profitable business, then you're in the right place. Please subscribe to my channel. Don't forget to hit the bell and you'll be notified every Thursday when a new video comes out. So how much business should you buy depends on three things that have to do with cash. Number one, it's down payment. Okay, how much down payment do you have available to invest in a business? And this is not money that is sitting on a HELOC waiting to be taken out so you can use it in a down payment. That has already happened. In fact, lenders don't want to hear that you're pulling money out of a HELOC. And if they do, they don't really want to see it until it's been sitting on a bank statement for 2 months, what we call seasoning. So that's number one, it's the down payment. So let me give you a specific example. If you had seasoned $100,000 ready to invest specifically just for the down payment for a 10% equity injection, that means that the bank is going to give you $900,000 or 90% LTV. So if you take the $100,000 and you divide it by 10%, it'll give you the purchase price. So if you have $50,000 divided by 10% equals $500,000. If you have 100,000 divided by 10% gives you $1 million purchase price. Now, the purchase price is different than the cash flow. I've done a lot of other videos and I have to figure out what is the optimal purchase price based on a multiple of cash flow. But for the sake of discussion on the cash you require and how much you should be looking to buy, it's down payment is first and foremost. If you have 100,000, you can purchase up to $1 million business regardless of the multiple. Now, number two is working capital. Now, people come to me and say, hey, Leo, I got $100,000 to invest in a business. It's great. And I ask them, are you a homeowner? What is your net worth? Do you have any other capital that you can tap into? That is working capital. Now, working capital is rather complex. And the bigger the transaction in the M&A world, the more attention is paid, especially with quality of earnings reports, to what the working capital is. So what is working capital? Working capital is the difference between your accounts receivable and your accounts payable, or your current assets and your current liabilities. Your current assets is everything including cash and AR, those are the two big ones, and prepaid expenses. Your current liabilities is your current payroll that is due, if you're doing payroll on accrual, and your accounts payable. The difference between those two is your working capital. Now, I'm oversimplifying it because there are more calculations that go in it, but say for instance, you have $200,000 worth of current assets or cash and AR, and you have $100,000 worth of liability. Say that is your current liability, that is your accounts payable. The difference is $100,000 worth of working capital. That is pre-assume that that's going to be what you need to run the business, which goes against your burn rate, which is your operating expenses month over month. What business brokers have to do is, if we're representing the seller, we have to figure out how much working capital they have to leave behind for the buyer. If I am representing the buyer, I have to figure out how much working capital we're going to need, because I don't want my buyer to pay for the working capital if there is no need. If I can get the seller to pay for the working capital, then it's working capital that you don't need. So if there is no working capital, and say that the balance sheet is stripped, there is no AR and there is no cash, and you really like the business and it's priced properly, somebody's going to have to get that working capital. Either you're going to have it in a savings account or a line of credit in your home, or somewhere where you can get that cash in case you need it, or the seller is going to pay for it, or the bank is going to have to factor it into the loan, which means you're going to get a bigger loan. But fear not. All of that it's part of the ongoing calculations that we do prior to due diligence, and they are verified during due diligence. Working capital is something that a lot of people miss. So say for instance, so that was number two, working capital. Number three is the post-closing cash flow. Okay, so what does that mean? I'm sorry, post-closing cash. All right, assuming that, let's play this scenario. You have $100,000 down payment. You get $100,000 worth of working capital from the seller. So for the first 30, 60, or 90 days, depending on what that is, you're gonna have cash within the business to pay for itself. There's no additional capital infusion that you have to do. But some lenders wanna know how much cash is left after you put your down payment and the working capital. It's figured out to the lenders and to the buyers and to their sellers satisfaction. Post-closing cash flow depends on a multitude of things. For instance, if you are a homeowner, now the lender can assume, well, if the event of an emergency, he can actually tap into the line of credit of his house, which, by the way, I would not recommend that if you're applying for an SBA loan, trying to look for a business, at the same time you're trying to find a home equity line of credit. Not a good idea. It's gonna kill. You're not gonna get either. Do you need help in buying a business? I know it's complicated, and if you're watching a lot of my videos, you know it's a lot to put together. Let's work together. Reach out to me. Let's schedule a free time to talk. You can reach out to me via my email address in the description section of this video, or you can drop me a comment below. Either way, let's engage. I'm here to help you. So post-closing cash flow is a matter if you have funds to tap into outside of working capital or down payment if need be, okay? Now, if you are a business owner and if you have a strong balance sheet and if you're buying a competitor or if you're buying a one degree, whether you're a vendor or a supplier, if you're in the same industry space, assuming that you have the management experience, and then you go ahead and buy a competitor, then the lender will compare and we will assist to compare the balance sheets of, the entity that you own and the new entity that you're buying and combine to see what it does for the working capital in aggregate, the sum of the two. If you come to play with a strong balance sheet and you're buying a business with a strong balance sheet, the post-closing cash situation may be moot because you may have the wherewithal, the financial wherewithal with your existing financial statement, with your existing balance sheet to make post-closing cash flow an irrelevant thing. Now, this is where things like when I talk to buyers and they say a buyer found me and they just reach out to me and says, hey, I want to buy a business, and I start asking a series of questions. Now, hopefully they're going to start to make sense to you. For instance, I want to know, hey, how much money do you have for a down payment that is seasoned? I will ask, how much cash flow do you have after the down payment that is left over? So if somebody has $100,000 to invest and that's all they have, they shouldn't be looking at $1 million business. Remember the math, 100,000 divided by 10%. The person should be looking for a business that is $500,000, because if they use 50% or 50,000 towards the purchase price, that satisfies the 10%. It leaves you $50,000 worth of post-closing cash flow, assuming that the working capital thing can be worked out within the business itself. That's what I owe, Do you own a business? And if you own a business, that can actually satisfy a lot of our requirements. Also, do you own a home? Do you need to own a home to buy a business with the SBA? No, the SBA does not demand that you own a home. However, it helps, okay? It's not impossible, it helps. So what is the other thing I ask is, what is your net worth? Net worth is very important because if you've been following my videos, before I was a business broker, I was a commercial lender and broker. So getting working capital loans is something that I did quite a bit for existing businesses that may or may not trying to buy a business. If a business wants to get an SBA loan for working capital, they will get a 7A loan, not a 504 loan. And the 7A loan, lenders are going to want for the personal financial statement, or I believe it's SBA Form 413. So what that form does is it gives you it's basically your income statement and your balance sheet all together in a very nice format that spits out your net worth. Whether you buy a business or not, you should know your net worth, right? So I asked, what is your net worth? Because it's a circumstantial case. So if your net worth, say, is, you own a home, you have stocks, you have a whole life insurance and a surrender cash value, cash in the bank, savings, and all of these things that are assets, and you have your mortgage and your credit card payments and your car payment, those are liabilities. And I don't think a car is an asset, but a car is an asset for the purposes of personal net worth. So you have all of these things figured out. And then your net worth is the difference between your assets minus your liability equals your equity or your net worth. If you have net worth that is substantial or a decent amount of net worth, the post-closing cash flow may also be alleviated. Remember, in this whole exercise, what you're going in with 10% and so hoping that either the seller will carry 10, 20 or more, and the SBA lender will give you, 80, 90%, depending on how the math works out, right? So if the lender is going to be at risk, regardless of the guarantee, and you're trying to buy a business, you want to make sure that it's all about lowering the risk profile. It's all about cash mitigation. It's all about risk mitigation. From their lender's perspective, they have the money to lend. They're going to lend it to you or they're going to lend it to somebody else. Whoever makes the strongest case gets the cash. So you need to be mindful of those things, all of those things. So to recap, the 3 types of cash required that will determine the ideal purchase price for you, it's going to be the down payment, working capital, and post-closing cash. Thank you so much for watching my video. For a limited time, I'm giving away my cash flow calculator, the one tool that I use just about every week to figure out exactly how much cash flow my buyers should be getting after the debt service when buying a business. It's a really great tool that you can use. It took me a lot to put together. It's my gift to you. All you have to do is subscribe to my channel, click on the link below, and you'll be taken to it. Thank you so much.